basically continues to be a narrow market. We did see a little reprieve there in late April when the Russell 2000 and the S&P equal weight index tried to play catch up a little bit, but they've rolled back over a little bit, and they're underperforming once again. And it just shows that a small number of names. Now, I understand that some of these names, like a Netflix and a Microsoft, a Amazon, they should be doing better, but that can only last for so long. When the rest of the economy is faltering, and when the economy does bounce back, it's not going to bounce back anywhere near to the level it was in 2018 and 2019, with the unemployment level probably going to plateau in the high single digits to maybe 10% or so. It's going to be very, very difficult. So I think it's going to be very tough for the stock market to rally any further, and narrow markets are usually followed by further declines, I'm afraid.
What is powering the stock market right now? The economic data, like the jobless numbers out this morning, unlikely to move the markets. Everybody knows the number's going to be terrible, whether it's 2.5 million, 3 million, 3.5 million. These are millions of Americans losing their jobs. So what data points do matter right now?
Well, it's funny. The employment numbers are going to be very, very important over time. The thing is, right now, what's driving the market is the Federal Reserve, and not just the money that they're putting into the market, but the faith in the Federal Reserve. The problem is there's a difference between what the Federal Reserve can do during a correction and a mild slowdown in the economy, and what happens in a bear market and a recession. When you get a recession, there's usually a second wave because the economy doesn't bounce back as quickly as people had thought. And especially in a situation where we are right now, where we got, leveraged investors were hurt very badly in March. The problem is leveraged companies are going to continue to be hurt over time because the economy is not going to bounce back in the way that it had been. And that's going to cause another wave, I believe, in selling because, like I said, the unemployment rate is going to level out at a level near 10%. That's going to be very difficult for the consumer to make a big comeback.
But you are still in the camp that this market, what we're seeing, with a little bit of strength, is kind of a textbook retracement bounce. We've seen it in the 1930s. We saw it in the internet bust. We saw it in the financial crisis in 2008, and that the path of least resistance for the overall market is likely lower.
Yes, and to be honest with you, I definitely feel that way, and I've only been emboldened by follow the smart money, as they say. We saw what Warren Buffett said over the weekend, and you can add Sam Zell to the list of a half a dozen or more billionaire investors who are saying that they're not buying right now and are looking for the market to retest the lows and maybe even undercut them.